Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook, and I'll be your host for the next 20 minutes here on Options Guide TV. All right, so I've realized that I really like Next Power. Now, it's interesting in that Next Power does not have weeklies on it, and I think that's a good thing. I've actually been at events and talked to the CBOE or been on panels and discussed we offer so many different expirations and so many different strikes that on good underlyings to trade, it is hard to trade them because the liquidity, it still is affected. You still don't have, even if you look at stocks like Apple and you look at daily or weekly options in Apple, you still have fairly wide bid-ask spreads relative to the price of the option. And so I like the fact that Next Power does not have weeklies and dailies and everything. And because of that, the market is fairly liquid. It's not amazing, but I like the volatility. I like the price. I like that it's $134 stock. We've done very well inside our portfolio on Next Power. We rode one open, well, we did a skip strike butterfly going into earnings, and that worked out well. Came back after earnings, and we put on another skip strike butterfly, which I'm going to scroll all the way down to the bottom of my screen here. Let's show this. And that trade is also working out well. So we have it at the 140 level. We're able, I've put a couple of these positions on inside my account. The days to expiration is 22 days out. If we look at the options grid, that June 28th is the shortest term expiration that is available. It's still trading at an 81% implied volatility. The historical vol is about 80. So there's nothing here that's crazy. We look at the chart in Next Power, I should say, if we can pull it up. And we see that this would be new all-time highs on Next Power Incorporated. And if we hit to those highs, this is basically, since the geopolitical issues in the Middle East, stock made a strong move up, plateaued, spiked earnings, back down, trading right here at 134. The all-time high here is 156. Our portfolio, we were able to get this trade done for about a $1 net credit to the account with that expiration. Now, there's only 22 days remaining now. I don't think we'll be able to get it done for $1 at this point in time, but I kind of want to keep going back to the well until it proves me wrong. So we have, whatever happens in the Middle East, if there is peace in the Middle East, which, that's a fun saying to say, the market could go down. But at this point in time, it's already had to run up because the news is the news. And so because of this, we've had to run up, we've had the plateau, we had a little bit of a bump up around earnings, and it's sold off. I don't really see a ton of catalysts at this point in time to drive it to that new level, to that new tier. It's been a very strong stock, and anything can happen, obviously, but I like that we can hedge ourselves. We can sell some of this vol premium and have a hedge just in case it happens. Now, 22 days remaining. If tomorrow the stock took off and hit our middle strike at that 170 level, we would still be in trouble. We're a little bit further out in time. And if next week on Wednesday we come in and do the trade and it's 15 days away, it's still the case. As long as we can get these things done and bring in a decent net credit, I think I want to keep doing it. I want to do a little bit of an experiment. Instead of chasing skip strike butterflies or butterflies overall just around earnings, let's look for fairly volatile stocks that have a decent market, and let's look at doing out of the money skip strikes as opposed to selling just short spreads. Now, a lot of people just like to do short spreads, and most people just talk about, if you're bullish, you're going to sell a short put spread. If you're bearish, you're going to sell a short call spread. But it doesn't embed that hedge. And you can do that on, well, I would even say a stock like Apple, short call spread, short put spread, very popular to do, take a position and do that. But Apple doesn't have enough volatility to make it worthwhile to do a skip strike butterfly. I guess that's the moral to my story. We need something that has 60, 70, 80 vol. Apple probably is trading at 30 vol at this point in time. A lot of times it's trading down around 20. It trades fairly close to the index sometimes. I mean, we have the VIX right now trading at 17. So yeah, that's where we're at. So here we go. Let's try this out. And we're going to go once again, a one standard deviation move out. Our order that we set up, we were able to go in the portfolio 5 and then 10. So if we can get that done and we can go 5 points and then 10, right about a one standard deviation move out. The expected move would be, expected move is a strong word because there's no earnings. But in general, if you look at the money straddle for the next 22 days, it's going to be somewhere around a 20 delta. So you can do that quick. We'll say we'll add the ask here and the bid here. That's 21 points. 21. So if you bought the ask and okay, so that's 11, 22 points. Okay, 22 plus 35. We're looking at 55, 57, right about there. And yeah, that's going to be right around a 20 delta. The 60 delta is 21. So we're right close to where if we bought the at the money call and we bought the at the money put, that's about where we're trading, right? So the marketplace says that this can happen, that there's a 20% chance that it could get up to this strike. Let's try buying this one. Oops, gotta delete this. We're gonna try buying this. Why am I click happy? That's the 26 there. Sell 2 of these. Let's start right here and then buy 1 of those. So this is around the 65, and we can get this done for 70 cents. So we're 5 points wide, looking at a midpoint credit of 70 cents. That means you're going to have risk from the skip strike to 70. And that is 5 points, and you're going to bring in 70 cents of that. If we did a normal, let's send this to the what if calculator, and then let's compare it to, let's say if we just sold the 65 and bought the 70, and I'm truncating the 1. Okay, so let's go back to trading. Let's clear this out. Let's just, as an alternative, we would sell this and we would buy that 120. So a lot of times it's about half is what I've expected. So if I'm getting a net credit at the midpoint of 70 cents, I would expect a net credit at the midpoint for the short spread to be $1.40. This is saying it's $1.20, so it's still relative. So if I just sold this spread, I sold the 65, bought the 70, there's an 19 delta, 19% chance that it could finish 1 cent in the money on the 165 call. And then I bought the 70, I could ideally, the markets are going to be a little wide. You're going to have to work this a little bit, but ideally, I could get a net credit of about $1.20. Now, we throw this butterfly in, and we bring a little bit less in, but we have the hedge. We have the fact that we're going to take some of this credit and we're going to pay for a butterfly. That is the ideal way for me to think of a skip strike butterfly, as it's an alternative to this specific short spread. So we'll send this to the what if calculator. And these are our two spreads. We'll bring this one back. This is the trade we're going to put in. And send that to ticket. Now, around earnings, I was able to get fills close to the midpoint. We'll see. And I'll throw this in my normal account and see if we can get filled around this 70 cent level. So that's the key. Around earnings, the midpoint was the midpoint. Obviously, a lot more eyes on it, a lot more people trading it. And because of that, that adds liquidity into the market. So it's a little bit easier to get filled closer to the midpoint. This would be the defining moment. We don't have earnings. We don't have this huge event. Have to see if we do this with 22 days remaining. The stock's got to break through the 160 level, which is that. Where was that on the chart here? Yeah, we haven't been there yet. So that's an all-time high. If we get there, the highest it's ever been is 156, and we got that long doji, I guess, that long finger out of the candle on a wick, I guess is the word that I want here. So we got to go all the way up and set an all new high. And then if it does that, we're still okay. We don't get in trouble on our skip strike until we get to the 165 level, which is right here. Here's 160. 165 is about where our break even is at expiration. And then our short spread risk kicks in. Now, if you put this trade on, this is the biggest thing to learn about skip strikes, is that it's a very schizophrenic trade in that it starts as a negative delta trade. You don't want it to go down. It's still the short spread is driving it. But as expiration approaches, the butterfly will take over. So we got 22 days. We're going to go out to the next month. We're going to go out to June. We're looking at the June 18th expiration. So we're going to go all the way down to 7 days remaining. And this isn't going to move a ton. Okay. Mainly because there's so much vol premium still. Now, in this last week, this is going to start morphing into the profit and loss calculator expiration graph. So it's going to start morphing into that, the what if calculator. So here we go. We'll go to Monday. So we're Wednesday. We're going to go to Monday. We're going to leave it, give it a couple of days remaining. And now all of a sudden, we're more profitable here at the 150 level. So we're putting this on for a net credit. And if this was the case and the stock was trading at 150 and everything else stayed the same, right? The what if calculator is saying we could put it on for 50 and take it off for a net credit. We could do it for a net credit on this position, and we would be up more than the credit that we received from initially putting on the trade. You could put it on for a net credit, unwind it for a net credit. Now the story gets better, but it's only in the last few days. We go to Wednesday, it gets a little bit better. And now let's go to the expiration graph. Now this is going to be 11 o'clock on expiration Friday. And that's where we end up at. So obviously you don't want this to go against you right away. It is a hedge. It is helping you. You are still long a call that you wouldn't be long on the short spread. So it is offsetting some of the risk. But if you do this trade, you ideally just want to make the net credit. So realize that this is an alternative to a short spread. And if it does start moving, you don't want it to start moving until the last week till expiration. You don't want it to get here. We have 22 days until expiration. So we got risk for, we'll say last week. So for 15 days, we have this risk to this upside. Now, if it blows through the strikes and if it hits this at any point in time between now and the expiration date, just get out. Just don't let yourself have this risk to the downside. Get out of the position if you can. And then just manage your risk. Just manage your risk. You've already put a hedge in for this trade. So let's manage the risk. If the stock actually gets here, let's just going to get out of the position. You could even say if it hits the short strike, I'm going to get out. But if we go all the way back and we reset the graph, we're going to go all the way back to the day is the 27th. And if the stock came up and hit the strike right here, I would get out of the, like if we put this on and boom, it hit 160, out of the position. Just don't try to mess with it because you're getting into this danger zone, and then time decay is not your friend anymore. Okay. So let's make this the paper trade for today. We got the 150, 165. So let's walk through it. All right. So we're looking at NXT, which is Next Power Incorporated. We're talking about the underlying stock being at $134.34. It's up $3 and change today, or about 2.5%. We're going to look at the June 18th expiration, 22 days away. We're going to be buying the 155 strike call, selling 2 of the 160 strike calls, and then we're going to skip the 165 and buy the 170 strike calls. So let me work through that again. So stock's at 134.55. We're looking at the June 18th expiration, 22 days away. We're going to buy the 155 strike call. We're going to sell 2 of the 160 strike calls. We'll be skipping the 165, which would be a standard butterfly. And then we're going to buy the 170 strike call. Now, by doing this, by skipping that strike, we're going to be able to get this done for a net credit. We'll call it, when we came into the show, it was at 70 cents, but now it's at 60 cents. So we're going to put that limit order in right now at 60 cents. We will have some risk from 165 to 170, just like if we were on a short spread. And we're going to send this trade down to the trading floor. And boom goes the dynamite. Order has been sent. All right. So questions. I see I put a NDX butterfly in. Yeah, let's take a peek at that one. I took an NDX. I put in an NDX butterfly for 12.18 with the strikes for 180, 190. I'm bearish for post-election. It seemed cheap to me. What am I missing? It is cheap. What you're missing at Dougal is that butterfly. I think if you just watched what I just went through on Next Power, 80% implied volatility and 22 days away, and showing you that it needs to get to expiration in order for this to really pay out on the butterfly side of things. So if you put the trade on, it is very cheap to put on, but you don't get paid until you get closer to the expiration date. Hence the reason why people like to do 0 DTE butterflies. That is a big reason why. And when we set up the trades on Options Guy TV, we will open a wing. If we're doing something in the NASDAQ, the NDX, we will just allow yourself to be profitable either on the bear side of things or on the bull side of things. If you're using puts, we would not make it uniform. We would stop short on the short spread and allow us to be profitable if the stock continues on down and goes below our strikes. But yes, that is the whole reason why you have a very expensive underlying, which creates premium. But you can't, if you're putting the trade on, I'll just put it this way. If you put the trade on for $1 and you can get out at $1, that's awesome. If you make $1 on the trade, don't be looking to try to capture $5, $10, $15. It's not a strategy that if you're going out that far in time that if you're correct on your forecast, that you get paid for right away. You don't have a lot of risk up front, but you don't have a lot of potential to make unless you're close to that expiration date. All right, so portfolio, let's go look at some things here. Our Google trade, our deep in the money Google trade, our delta's at 1, and we need to trim this position. So whenever the delta, and here's the delta line, whenever we see it get to 1, it's time to take that trade off. And it was probably time before, we ran through earnings and didn't pay a ton of attention to our deep in the money option contracts. But this is a great example of we're up, we've doubled on our position. We're up 95% on the P&L since we put this trade in. Do we still like Google? I do. This is one of my biggest holdings. I actually need to trim it back a little bit in my own portfolio, just the underlying stock. But we have 51 days remaining. We need, if we're still bullish, the ideal situation would be when this says 100 or 1. That means the delta would be 1.0 on one option contract times 100 is 100. And that's where the delta comes in. And that's why it's showing you 100. This is basically acting like the stock. We're so deep in the money on our Google option contract, though, now that our bid-ask spreads are getting wide. And so that's part of the reason why we want to control this trade and why we want to roll this out in time. So here's how we're going to go. We're going to keep our position on. We're going to be selling to close the 280. And we're going to go, let's pull up the options grid. Let's go out another half year. We'll go out probably 120 to 130 days out. Let's go just shy of half a year. And let's put in Google. June 18th is 22 days away. Let's look at September or October. That's a tough one. Those are tough months just in general. We'll go to September. So our September contract, the stock's at 390. It's up $2 today. We're going to look at somewhere around the 80 delta. And I always like to look at open interest. If I have a 79 delta with 750 open interest, or an 81 delta, right, if we round up, with 3,500 open interest, I'm going to lean towards the open interest. I'm going to follow it. Doesn't necessarily mean that you're going to have a great market, but you do have more people interested. So I'd rather have more people own this position than less, right? So it's 66 by 64. And our one option contract should be a little bit tight, but here's how we're going to roll. We're going out to the September 9/18 expiration. We're going to go down. We got the 280 strike. We're going to go down to the 3,500 open interest. We're going to go up to the 340 strike. And we're going to bring in a net credit of 48 cents. Okay, so it keeps us bullish in delta. It gets us back to an 80 delta. It gets us a little bit tighter market that we're in. We take some of the money off the table. We still remain long. We go further out in time to show that we're still liking Google or Alphabet at this point in time. And this is how we manage our deep in the money option contracts. And like I said, if it wasn't for bid-ask spreads being wide on these option contracts, this is the only way I would trade. I wouldn't buy stock. I would just trade the option contracts, because you have a lot less risk on the downside, because if it just blows you away, you only lose what you paid for the call. You still have the upside. You still got a battle time decay. So you can sell calls against the position from time to time. It's a little bit trickier on a deep in the money option contract, But now we're taking in $4,850, taking some of that money off the table, and we're still going to have something that is very representative of the stock. So right now, I like where this limit is. This is a net credit of 48. The midpoint is 48.50. I would try working the midpoint. If I had this on in my own portfolio, we're using a paper trading portfolio here. So we're going to go, we might actually have to go down. Let's go 47. See if we can make sure we get it executed. And I'm going to go good till cancel just in case, because I've already had this happen to me where I didn't get it executed and then I had to go back in the next day and clean up the portfolio. So here is our paper trade. Here is our management of our deep in the money Google position. We're going to sell to close our big gain on our 280 strike call option with the July 17th expiration, and then we're going to buy to open the 340 strike call option, rolling up to an 80 delta, going out further in time with the September 18th expiration, 114 days away, bringing in a net credit of $47 to the account, and boom goes the dynamite. Order has been sent. All right. Any other questions? We probably need to go back through our portfolio and adjust some of these positions. Our Netflix call, we're probably going to have to get out of our Netflix call. It's at 20, it's at $6. Netflix is at 90. Yeah, we're at 88 on the underlying stock. So we're down quite over 50% on our position. What I would do on Netflix with our option contract is we could sell some calls against the position. We're still up on our stock, but we did our call option after the earnings report. So we'd have to decide, do we want to remain bullish on Netflix or do we want to just close it out? I'm going to stay long our stock and we're going to close out our short option contract until we see, or our long call option contract, because our rule is that if it hits our 90 strike, we got to get out. Stock's at 88.30. Should have got out when it hit 90. And we're going to take that risk off the table. We'll close at midpoint. Here is the order entry, and boom, send that one to the trading floor. All right, so we're getting out of that position. What else could we look at? NVIDIA, long 3 of the calls. Don't remember our 280 call. 270, we buy that around earnings. 259. Oh, we did a interesting. I don't remember exactly what when we put the NVIDIA position on. I'm going to have to go back and look at that. Our Apple trades. Oh, the NVIDIA. Yeah, that's right. This is part of Fundamental Friday, and it gets put in here, right? So we have 2 different trades on in NVIDIA. That's why we bought 3 and we bought 1. All right, I got that. That's Fundamental Friday. That's not necessarily matter in here. 33 on our deep in the money call. This is at 270. Underlying stock is at 277. So we're not there yet, but CME, we got to watch that one close. And our Apple is also Fundamental Friday. All right, I guess that's about it. Netflix, we close out the position. We got the gain in the stock. Oh, Dell, we got Dell. Deep in the money call. Yeah, we've done really well on Dell too. This Delta is getting close to 1. We bought this for, oh my gosh, we bought this for $8.50 and it's at 82. Did 2 option contracts. We did a diagonal spread, and we were long the call option going into earnings. So we sold a short-term spread and bought a long, or we sold a short-term call that expired worthless. and then we bought a long call that went out in time. So we bought this for 850 going into earnings, and it's now trading at 82, and the delta's at 100. So we need to take this position off. And then we got to decide if we want to stay long Dell inside our portfolio. So let's go look at our orders, and then we'll call it a day. A little bit long, got a little bit of a late start. So this is the trade that I want to make sure gets executed, because this is a position we've had on for quite some time in Google. Dell, I might just throw this one in at market and take that gain, get that done. And then Netflix makes me sad. I still really like Netflix. I think Netflix is a great covered call. Even the wheel strategy, where selling puts to buy more, it's a $90 stock. And the potential, there's really no reason in my mind that we can't get back to the 34 level. It doesn't always, it trades at a fairly high PE, but it always has. Since it IPO'd, Netflix has always traded at a higher valuation. So I think it can handle that. This was the downturn from when they were in the bidding war with Warner Brothers. Stock came up, we ran up. This ran up into earnings, and then we actually pulled back a little bit. But I do see Netflix making headwinds as far as they're trying to get into sports. They're flush with capital because this didn't happen, because of the Warner Brothers Discovery did not happen. Nothing went through. That merger didn't happen. And I don't see any reason why we can't at least get back to this 108 level and beyond. So if we close that out, let's roll. Let's get long another Netflix call. We'll keep in our short position. And if we want, we'll sell a call against that. I actually don't mind doing, we did a couple of these. Let's look at the vol in Netflix, where we did the cover call on steroids. 37. That's a little tough. We need a little bit higher vol in order to make that work. It's not bad vol. Yeah, this is a real good. If you're looking to do the wheel strategy, Netflix is a real good stock to do the wheel on. Sell the put to buy it. You get put the stock, sell a call against it. Go back out, sell another put if you want to buy more. And if the call expires worthless, sell another call against it. You got enough vol, you got some volatility, some predictability. Netflix isn't going away. Obviously they're not going bankrupt anytime soon. And so this is just a real solid stock to generate income on a stock that is a good stock, but has just decided to trade sideways. And we're right in the middle of this gap too. Man, you'd think we'd have to fill that gap, right? At least get back in the short term, get back to the 90 level. But man, we've been trading right in. So much for filling a gap. I mean, we brought it down once this was definitely a level of support right here, right? And that support did not hold. And we filled the gap almost, well, we did to the downside, came all the way down to here. And now we're just, now that's a resistance level. And if we can break through 91, I would definitely, I wouldn't mind even getting long, just shorter term calls at 91, from 91 up to this high end of the candle, from 91 to 94. Because this is definitely a level of support on the downside. 1, 2, 3, 4, 5, 6, 7 times it touched that level and bounced until it eventually broke through. So this is definitely a spot where you would want to get out of the position when you saw it break through this, and now it's working its way back up. All right. Well, a little bit extra today. I'm liking my experiment on NXT. So to rehash that, a nice underlying, um, decent volatility, no weeklies, which gives you less choice, but also makes the markets a little bit more feasible. We got wide markets as it is, but it allows you to work the order a little bit more. You got a stock that has reached its high. It's already came up after. We know a big reason why the stock had the big run up is basically news across the globe, everywhere. Power is a big theme, and we plateaued. Now we've came back down. So is the stock going to set an all-time high again? Volatility is there. You're getting paid for doing this. You got a hedge already built in. Yeah, we're going to keep doing this. We'll do this again next Wednesday. Let's put another one on next Wednesday. See if we can get it executed. Not filled in real account trading yet. Yeah, we'll see if it can fill. Like I said, it filled around earnings. That's going to be an issue. Well, Kurt, share that last little comment. And that was at 70 cents, I assume, Kurt. All right, let's see if we can get it done at that level. I would go down as much as maybe 50 cents. I'm still okay with 50 cents, 5 points wide with the hedge in. So that would be like selling the normal spread for $1 on a 5-point wide spread, one standard deviation move out of the money. So if I could get it done for 50 cents and have that hedge in there, I would take it, but I wouldn't want to go below 50 cents with where the stock is at. All right, that's it. That's it for this edition. Now, Friday is Fundamental Friday. If you want to support the show, let people know about it. Please, we want to make it as interactive as possible. If you actually sign up for the Tradier account, you click the link that's down below the show. You can paper trade right along with me. We do all the paper trades on Tradier.com, the very simple platform, very straightforward platform to paper trade on at Tradier. And you can also, obviously, you can trade inside the Tradier Pro portfolio, and it actually combines both the portfolios if they're in the same account. So hence the reason why I got a little bit confused about NVIDIA, because I knew we weren't long NVIDIA, but we're going to look at those positions. So if you let people know, Fundamental Fridays, every Friday, covering the basics of options all the way from buying calls to eventually selling short spreads. Thanks for coming in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.